Hello, everybody, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way to exit highly appreciated assets tax deferred so you can create, preserve, and grow your wealth. I'm your co-host, Pearson York, filling in for Brett Swarts. In each episode, I'm joined by some of the best wealth, business, leadership, and real estate individuals in the world to share ideas, deal stories, and inspiration, so together we can make complex tax deferral strategies simple and passive income plans achievable. As always, we're streaming on expertcresecrets.com and the Capital Gains Tax Solutions YouTube channel. So please smash that thumbs up button for us. It really helps us out. We really appreciate it. Thank you so much. Our next guest has been in the financial advising and tax strategy and tax planning world since '99. He's got a wealth of knowledge. I'm super excited to talk to him. We're going to have an awesome conversation. So please help me welcome Chris Holm. Chris, how you doing, man?
Hey, how's it going? Thanks for having me on the show.
Yeah, absolutely. Thanks so much for coming on. We really appreciate it. So Chris, or Kirk, tell us your story. How'd you get to where you are today?
Yeah, well, it's funny. I started in 1999, December of '99, if you could believe it. And it was the peak of the tech bubble. I was in college, trading stocks in my dorm room, and decided I want to do this full time. And it got started December of '99, and it was all downhill from there. If you look at the stock charts. So it was actually a really rough few years to start in the business, but it gave me an appreciation for risk management. Because anybody who started in the '90s just thought stocks only went up. Really, since 2009 is really the same thing. If you started there and on, you thought stocks only go up. So it gave me an appreciation for risk management because I had to first few years just to survive as managed risk. And over the years, I've changed different firms and just tried to find really the optimal situation so I can help provide my clients with the best solutions and really the most flexibility in determining what makes sense for them. I think most people in our industry, licensed advisors and brokers, tend to want to sell product, and we don't sell product. We advise our clients. So I really don't care what the solution is. I don't have any bias one way or the other. I just care that it's the right thing for them. So we're really on the lookout. We're always on the lookout for new and different solutions and ways to manage risk and manage tax implications for clients.
Awesome, and I love that. It's putting the client's needs first and not necessarily your own. So it's really admirable. What are one or two strengths or spiritual gifts that you have that have led you to be successful today?
That's a good question. I would say tenacity, grit, integrity, empathy, and I kind of look at, we have some core values. I would say kind of having a growth mindset as well. I think the industry has some big challenges, and one of them is that people are really focused on selling a product and on really their own selfish purposes. I don't mean people are selfish, and I don't mean they're doing the wrong thing. I mean, the industry teaches you to focus on doing what is more product centric as opposed to client centric. And people talk about being client centric, but they're really focused on product centric. And we're not. I don't, like I said, I don't care what product you use. I care what is the best fit for you. And this has caused us to be a lot more innovative and seek out solutions, even create solutions that are solving problems that the industry is not solving. Look at what's going on in the markets this year. Everybody thought having a 60-40 portfolio was the best strategy, or being all in FANG stocks or whatever. People thought bonds were safe. And our ability to think outside the box and to look at the situation in a different light allows us to bring something new to the table and come up with solutions that are really not out there in the market.
Yeah, that's super interesting. So having a holistic approach to, their investing strategy, as well as, really going after what the client needs and innovating when, it doesn't make sense to zig when everyone's zigging. Is that sounds about right?
Yeah. Think of it this way, like, the stock market, for example, people just normally make certain assumptions, what I call half truths. So one of those half truths is bonds are safe. And what they don't know is bonds aren't safe. They have been safe for 40 years. That does not mean that they're going to be safe for the next 40 years.
Right.
But I think people hear something and they don't bother to think about why it's true. They just assume it's true. Diversification of a portfolio, people assume is true. It's not true. It's true sometimes, but not all the time, right? So it's not really true. It's a half truth. And I think what's common in Wall Street is people take these half truths and they assume to be 100% true, and they don't understand why. So diversification, for example, it's a great way to manage risk. But I would say you're not actually managing risk. You're managing volatility. So volatility is when things go up or down. Risk is what I call a permanent impairment of capital. So it doesn't have to be permanent, but that's the term we use. So 2000 to 2013, if you were in the S&P 500 or any index, frankly, you lost money for 13 years. It wasn't until July of 2013 that the markets actually were positive again. And so when we're looking at, portfolios, we're looking at, all right, are you going to be losing 13 years of time of non-compounding because you didn't understand risk? And, I think like this year is a good example, whether you're in stocks or bonds or whatever. And real estate, I don't know about real estate, it's down, but in the stock market it is. You're down like 20 to 30% right now. In some cases, more than 30%. I mean, 30-year treasuries are down, I think, 33% as of today, approximately. That's safe. Safe bonds. They're not safe. They can be safe. And I think what's misunderstood by people is they need to understand why. So what we do as a firm is we deconstruct why things work and why they don't, and we come up with better solutions that work in other scenarios. So our solution for money management, as an example, is to manage risk first, and performance takes care of itself. So this year we've been fine. 2020 we were fine. 2008 we were fine. Like, these big times that cause people to have anxiety, we're fine. Like, our goal is to make money when the market goes up and not lose when it goes down. I mean, that's our intended goal for money management.
So what's the number one secret to managing the money properly?
Risk management first. So think about it this way. People try to manage performance. They try to beat the index. Everybody does it, right? We are naturally, as human beings, we are outcome-based thinking. That's how we all think, right? What's the weather going to do tomorrow? What's the stock market going to do? Who's going to get elected? Those are all outcome-based thinking questions. What we should be is scenario-based questions. What are we going to do if this candidate wins? What are we going to do if that candidate wins? What are we going to do, in the sake of the last presidential election, what are we going to do if it's unclear, right? Like, how are we going to act in different situations? And I think that kind of thinking opens you up to managing risk better. So, for example, if you're in the stock market, you have one of three outcomes. The market's going to go up, it's going to go down, or it's going to go sideways. You can make money on two of those three outcomes. You cannot make money on three of those three outcomes. So you can choose if it goes up, you can choose if it goes up and sideways, up or down. Any of the three, you can come up with a strategy to make money for any of the three, depending on what you think should happen. You just have to account for the fact that you're not going to make money in that third scenario. And the question is how bad are you going to lose in that scenario? And if you set it up in such a way so you lose really, really badly, then you obviously are not managing risk. So we look at, I think it was Benjamin Graham who said this, that you can't manage performance, but you can manage risk, which is true, right? We don't know what the market's going to do. I don't know if it's going to go up or down, so I can't manage that performance. But I can tell you, I can set up risk management in such a way so I can tell you, I will not lose more than X amount of this portfolio. I can create that for a client. Very, to the penny, I can create the loss. I just can't create the outcome or the performance, because that is unpredictable. That is knowing the future, which of course nobody can do. So that's really where we differ, is that we're not just saying, oh, put it in this and you're going to make 6%, 7%, whatever. You can't know that. That's total guesswork.
That's interesting. Okay, so in the managing of the risk, how do you guys how do you account for, as the portfolio grows, right? You're managing the risk. Like how do you move the
risk management measure? Yeah.
How does the risk management move with the growth?
So it can be done different ways, but it depends on your time frame. So I like 1 year time frames, which of course is always moving, right? You're not going to always have 1 year, but I like looking at things in 1 year time frames because everybody looks in 1 year's time frames. Now we also look in 5, 10, 20-year time frames, but generally speaking, if we're looking at managing risk, we're looking for it about a year. I like the calendar year because things tend to happen. Oddly enough, things tend to happen on the quarter or they happen on the calendar year. So if you notice, if you look back in certain quarters, the market bottoms out in a certain quarter and it tops out in another quarter magically. September, the end of September always happens. It doesn't always, but if it's going to be down, it frequently happens at the end of that quarter because hedge funds are selling out, rebalancing. So there's reasons for that. But if you look at this summer, it was at a low. So I think you have to understand the time frame that you're looking at. But I like the year because it gives you enough time to figure out, all right, I need to make changes to this strategy. So for instance, um, let's say, for example, I wanted to, let's say the market in the first quarter goes up like 30%. And I decide, you know what, that's a lot. I'm going to pull up my risk management tools and I'm going to raise them from where it started up to 30% because it could certainly go up 50, but the probabilities is probably not going to go much higher than 30. So I think I can kind of, I don't want to say lock it in, but I can kind of lock in a lot of the gains so that even if it goes down, then you're still going to have a lot of those gains locked in. So there's a little bit of an art to it. Just like there's an art like 2020, right? Like we actually, and I'll say it's total luck, but like a week before COVID hit and the market started to crash, we locked in, a lot of the upside. And I can't claim it's skill because nobody saw that coming. So, but I will say that we were fortunate enough to do that because it had run up a lot, and we decided it was a good time to do it. But then after the COVID sell-off, now we're looking at a different scenario and say, all right, how can we take advantage of this and look at a way to make money at a time where everybody is losing their minds? Because generally speaking, those are the best times to make money. I mean, we were looking at certain investments that, generally yield 7% that were yielding like 15, 20% yield. And these are bonds, and they weren't going out of business. They were just, people were selling indiscriminately, and we saw an opportunity and said, hey, let's jump on this. And they ended up going up like 80, 100% in a matter of 2 weeks. Once again, pure luck. We saw the opportunity and we said, this is a good opportunity. The fact that it went up 100% in 2 weeks is luck because that was also crazy. But the point is everybody was losing their mind. So you can come in with a rational head. If you haven't lost 20 or in that case, 30%, you're not losing your mind. You're thinking very clearly. You're thinking, is this a good time to buy? And then you can go in and you can cherry pick good opportunities, take advantage of them, and then, get out and go make money other places. So I think the one thing I
Yeah.
learned from 2008, just really quickly, like I went through 2008, we got into cash 2007. We wrote out 2008 in cash. Everybody around me was losing their mind. I have to say it was a great experience to have, not because we didn't lose money for clients, but because I got to see the emotion being thrown around all year. And I think if you're in it and you're down and you lost money, you can't think clearly because your brain shuts down. You're in fight or
Right.
flight mode. But when you're not in that fearful mode, you can actually think clearly. So it was really easy to see what was going on and how to take advantage of that at that point. But if you're down 20 or 30%, you're not thinking clearly. It's really hard to do as a human being.
Yeah, that's super interesting, and I guess that kind of speaks to the power of managing your risk and first and foremost more than anything else, because if you can, and you're not down 30, yeah, that makes a lot of sense. So how does tax strategies play a role in this, and how do you guys use tax strategies in order to kind of maintain that protecting your downside and whatnot?
Yeah, I mean, you have a interesting tax strategy that you guys do. We have a different one, which we actually, as a firm, specialize. Which is one of the reasons we started the firm was self-directed IRAs. And basically, what it is most people think your IRA can only be invested in stocks, bonds, and mutual funds. Fortunately, the rules don't say that. What the rules don't even tell you what you can invest in. What they tell you is what you cannot invest in. And that means you can invest in virtually anything with your IRA. You cannot invest in life insurance on yourself. You cannot invest in S corps or collectibles. Pretty much anything else you can invest in. And so what I like is I really like the ability to um, I like the ability to be creative with clients. So for example, if you wanted to buy a rental property in your IRA, you could do that. If you're making 10, 15%, great. That's a great way to generate, tax deferred, or in the case of a Roth, tax-free income.
Yep.
We've seen some crazy things. We've seen clients, and these are not my ideas, so don't think that I've got all these ideas I can provide people. We have clients that come to us who want something alternative, which we do have. And then we have clients who come to us with something very specific that they're good at. And that's what I'm going to talk about, because otherwise you're going to be inundated with people who think that you can get these returns. I mean, I had a client who was making 80% a year on fishing rights. It's something he knew inside and out. He had his connections. It worked for him. I couldn't do that. Yeah, I
Yeah.
just wouldn't. There's part of the thing is, when you see these niches that I see that do really well, they're not scalable. Like, you couldn't have an institution come in with $1 billion. They're not big enough. Another lady is making like 300 to 1,500% returns a year in what she did, and she's doing like debt collection stuff. So obviously, also something that not all of us can do. I
Right.
couldn't do that for other people, but I love the fact that she could. To me, it brings out the fact that you can be creative with your investments. I mean, look, if you bought, give you a perfect example, a simple one that anybody could do. You let's say you find a property that's worth 100,000. You're able to lock up under contract for 30. Well, let's call it 50, right? Let's say you lock it up for 50,000.
Okay.
That's a deal, right? It's 50%
Yeah.
discount to market. Well, let's say you didn't want to close and buy that, whatever. You don't have the money, the time, whatever. So you wanted to flip that contract to somebody else for 75,000. You just made 25,000 on that, and all you did was flip a contract to somebody else. Now, take it for real estate, take it for the IRA perspective. Let's say the IRA puts $100 down on that contract to lock it up. And then you flip it and you make $25,000 based on a $100 investment. What kind of returns do you have there? I don't know, but it's a hell of a lot higher than you would
Exponentially.
in your
Yeah.
stock portfolio, right?
25,000.
Right. I mean, you could do it with any amount. I mean, you look at Mitt Romney; he's got a $106 million IRA. I mean, there are actually multiple
Right.
people who have $1 billion IRAs, if you can believe it. I think Peter Thiel has a $1 billion Roth IRA, which means he doesn't pay any taxes on that, which is
Yeah.
amazing
They're
to me.
all up in arms in it. It's
Right,
funny.
but they're mad because they couldn't do it. Because if
Right.
they did, they wouldn't be mad, right? And here's a guy who's smart, who's resourceful, and said, "I can do this, and I'm going to do it." Great for him. I wish I had the knowledge and the resources he had to do that. But look, I mean, anybody can do this. That's the point. This is
Right.
something anybody can do. It's a little complex, but it's something that I totally back the fact that people should invest in what they know, as Peter Lynch said.
Yeah, absolutely. Okay, so you guys use the self-directed IRA accounts and self-directed Roth IRAs to give people the creative opportunity, either grow tax-free or invest the taxed seeds. So in virtually a whole bunch of different things. So does that mean that your firm offers a variety of different like assets and stuff to invest in besides just the standard I don't want to say the standard financial advising like product, right? The funds or whatever, but do you guys do like real estate deals? Do you offer any of that type of thing? Do you strategically partner? How do you guys actually do that?
So we're independent RIAs, so we're fiduciaries, so we don't sell product. We don't have product to sell. We have people that we work with, we call investment sponsors, that we are familiar with, and we've done a lot of due diligence on. We actually do a lot of private mortgages, or hard money, as they're also known, and we've been doing that since 2008. My partner's been doing it for 10 years prior to that. So we've been doing it a long time. We like it as an asset class. Unfortunately, in the last
Yep.
5 years, there wasn't much inventory because real estate was so expensive. So these people couldn't make as much money. This year,
Right.
I think we've done the fewest private mortgages we've ever done. We're lucky to get a handful because the prices were just ridiculous in this part of the country. But every one of them has been telling us next year we're going to see a tidal wave if rates keep going the way they are. Which means that there's a ton of opportunity out there if you do your homework on them. And I mean, for instance, 2008, 2009, 10, we had more notes than we had clients with money to put in them. And now it's the exact opposite. We just have no notes and we have plenty of people clamoring for, like double digit returns. You just can't, you have to find the balance, and we're not willing to put risk above returns. Like the returns are good. They're really good, but we're not willing to put risk above that. So we just, we're doing it because people want income. They want sustainable income, and they want something that is relatively low risk to what they're doing and a good diversification outside the market. But, I can't go out and sell this, because I'm not allowed to regulation wise, but also even if I could, it's not for everybody, right? Like everybody's different. Everybody has a different risk tolerance and interest. We have some clients that are 100% in alternatives, and we have some clients that are zero. Like everyone's different. Like
Right.
I use alternatives, but I'd be fine if I didn't. They're just another investment. They just happen to be outside the market.
Yeah, that's super interesting. Kirk, when it comes to the loans, the hard money loans, how are you guys looking for more loans right now, given the current market situation and the debts? Are you guys on the sidelines just kind of waiting? If you had loans, would you be interested in fulfilling them? What's the front on the mortgage side of things?
So we work with a handful of investment sponsors that we worked with for a long time. So we know them, and we know they know what we want. We know, their business. We're very comfortable with that. I think the challenge is, we're always looking for new people, but it's really hard to find new people that are good. It takes a lot to get into our network. The way I kind of look at private loans or hard money is you can buy it for income, which is a little bit more conservative and the yields are lower, or you can buy it for, total appreciation. Now, what a lot of people do is they'll basically become loan sharks, if you will. And there's nothing wrong with it. I mean, you can make good money doing this, right? If you loan money to somebody for pennies on the dollar, you try to make the loan performing, and maybe you sell the loan or whatever you try to do. There's so many paths there. You can make some really good returns doing that. We don't do that because it's a huge amount of work and hassle, and the clients don't want that kind of headache. They don't want to have to deal with lawyers and foreclosures. And I mean, it's a total nightmare for a client who just wants to go about their job and go hang with their family. They don't want to have to deal with this stuff. So we've found really kind of the lowest risk in the category. So we're always looking for more, but look, we're consider it like Jim Rogers said with his investing style. He waits till there's a pile of money sitting in the corner of the room, and then he goes picks it up. That's his investment style. He's not going to push. He's not going to do things just to do things. He'd rather just sit around and wait until it's obvious and make lots of money. We're the same way.
Gotcha.
We haven't done a lot of notes this year, and it's sad because a lot of people want them, but it's the right thing to do. We have a lot of cash in our portfolios right now across the board. People aren't happy about it. Well, they're happy because they're not losing money to the market, but they want it to be invested. They have this feeling, I need to be invested. I'm losing to inflation. But you're not losing to inflation. Inflation affects everything equally. What people are looking at real returns saying, oh, it's down 8% to inflation. I'm like, yeah, but your stocks are down 30% plus the 8%. Which one's better?
Right.
-8 or -38? So I always look at things in nominal terms because inflation doesn't pick on cash. It picks on everything. So I think the way to look at it is,
That's interesting.
I mean, people don't look at it that way. It's a different way to think about it. But I think we're all conditioned to look at investing in finance in a certain way. And it's not always the right way. It just so happens to be the way that people have been conditioned. And that's why we always look at assumptions and say, what are we missing here and what needs to change? So that's kind of how we look at it.
Yeah, and I think that's really wise, actually, because I haven't heard of it that way either. And I think there's a lot of wisdom in what you're saying. So I hope you guys are, appreciative of the value that Kirk's providing right now, and just the wisdom he's speaking, because keeping that level head, keeping the emotions out of it, and making sure you guys are making good, wise decisions, is protecting your downside is definitely going to be way more advantageous than just YOLOing into Dogecoin and being that guy. So it's a breath of fresh air to hear, okay, hey, just slow down a little bit, like let's take a look at what's really going on, and let's really think through this thing. So that's awesome. Kirk, where can people find you?
Yeah, so I'm pretty easy to find. You can find me at innovativewealth.com. That's our company website. I also have a popular investing podcast called Money Tree Investing. It's one of the longest running investing podcasts out there. We have 2 shows every week. We have one show on Friday, which is really more talking about alternative investments and, different interesting parts of finance. And then we have a Wednesday episode, which is more timely, talk a lot about inflation every week and all the factors that are changing in the market. So if you really want to know what's going on in the market, we have a very different take about how we do it. It's not just, we don't tell you what to think, we tell you how to think. And that's why we're very different as a podcast. So it's the easiest ways to find me.
Awesome. And we didn't really get into it today, but you kind of briefly touched on what we do. It's we have an alternative strategy to the 1031 where you can defer capital gains tax and reinvest the proceeds into whatever you want. So, Kirk, we'll have to talk offline about getting on your podcast and sharing with your listeners some of the stuff that we do. It might be useful for them and helpful for you guys as well. And you guys can find that at, if you want to learn more about that, you can go to capitalgainstaxsolutions.com. We have a mastermind every Friday at 10 a.m. Pacific, 1 p.m. Eastern. You can come on, learn, ask questions, talk to us. It's a great place. So make sure to check that out. Okay, Kurt, we're coming up on our time here. So I went over a little bit, so sorry about that. But wanted to just plug one more time. So innovativewealth.com. You can find Kirk on there. And any parting words?
I guess the parting words I would say to your audience is, this experience we've had this year is just a drop in the bucket for what we're going to experience the next 5 to 10 years. We're entering a new paradigm. It is not like the old paradigm, right? It is, the last 40 years were very particular to that period. And this year was the start of a new paradigm. And I think everybody needs to reassess their assumptions. It's not all going to be bad. There are definitely going to be bad periods and there'll be good periods, but you need to look at things differently and not make assumptions based on history. Because if you want to make assumptions based on history, look at the 60s and 70s. That is the period you should look at if you want to know what is going to happen in the next 10 years or so. But just, that, and just honestly, just do your research, do your own due diligence, and, frankly, come up with your own opinions. Don't get them from other people, even from me. Just come up with your own thesis and, follow it. I mean, you have an expertise in your life that you're good at. Do that. Don't, if you're really good at real estate, don't go buy a diamond mine, right? Do what you're good at.
Yeah, no, that's awesome. And that's interesting about the 60s and 70s. Hopefully, we don't get like a crazy Woodstock coming back and something like that.
Well, that's probably the best part of that.
All right. Well, Kirk, thanks so much for coming on. Really appreciate it. Really appreciate all your wisdom. And thanks everybody for listening to another episode of the Capital Gains Tax Solutions podcast. As always, using a proven tax deferral strategy such as the Deferred Sales Trust, the best way to exit highly appreciated assets tax deferred. Not having a clear plan is the enemy. So make sure you guys get a plan. Make sure you guys are protecting your downside. Keep listening to wisdom and stuff from the people like this on the show, and make sure that you guys don't do anything dumb with your money. Please rate, review, subscribe. We appreciate it. Kirk, thanks again, man. Really appreciate it. We'll talk to you in the next one.
Thanks for having me on.